In today's session, we will discuss the lease accounting from the lessee's perspective. We will start with the initial measurement. The question is, what the lessee must recognize at the lease commencement date. To answer this question, the general rule for both finance and operating leases, a lessee must recognize at the lease commencement date 1. Lease liability, and 2. A right-of-use asset. What are the similarities and dissimilarities in accounting for finance and operating leases? Finance and operating leases result in the same accounting for 1. Initial recognition and measurement of the lease liability, 2. Initial recognition and measurement of the right-of-use asset, and 3. Subsequent measurement of the lease liability. However, finance and operating leases result in different accounting for subsequent measurement of the right-of-use asset. How lease liability is measured at the lease commencement date? At the lease commencement date, a lease liability is measured at the present value of the lease payments to be made over the lease term. To arrive at the present value of the lease payments, a discount rate should be used. Has the identity of the discount rate to be used in this connection been defined? The discount rate to be used is the rate implicit in the lease if known to the lessee, but if the rate implicit in the lease is not known to the lessee's incremental borrowing rate is used. Wait a second please, what the lessee's incremental borrowing rate is? The lessee's incremental borrowing rate is the rate of interest that a lessee would have to pay to borrow the funds necessary to obtain an asset of the similar value to the right-of-use asset in a similar economic environment over a similar term and with a similar security. Are there specific terms for the lease payments that should be considered in calculating the lease liability? The lease payments used to calculate the lease liability depends on the specific terms of each lease contract. We need more details on this particular item. Well, if the lease includes a purchase option that the lessee is reasonably certain to exercise, the lease payments consist of 1. Lease rental payments plus 2. The exercise price of the purchase option. However, if no purchase option exists, lease payments may have 3 components. These are 1. Rental payments, 2. Any penalties for terminating the lease, and 3. Amount probable of being owed by the lessee under residual value guarantees. I observed that you used the phrase amount probable and not the full amount under residual value guarantees. What is the reason behind it? Good observation. For the substantially all of fair value lease classification criterion, the present value of the full amount of the residual value guaranteed by the lessee is included in the test. However, in measuring the lease liability, only the amounts probable of being owed by lessee under residual value guarantees are included. To make residual value guaranteed topic clear, you are required to give us an example. Assume that in a lease contract, a lessee guarantees that the residual value of the leased property at the end of the lease term is at least $50,000. At the commencement date, the lessee estimates that the leased property at the end of the lease term will be only $40,000. Thus, it is probable that the lessee will owe $10,000 to the lessor under residual value guaranteed, the present value of which is included in measuring the lease liability. However, to test the substantially all the fair value lease classification criterion, the present value of the full amount of the $50,000 is included. We appreciate. Would you give an example of how to calculate the lease liability? Okay. On January 1st, year 1, Salah we Abdel Fattah Company S&A entered into a 3-year lease of a machine from a lessor. S&A must pay to the lessor 3 annual payments of $100,000 starting from December 31st, year 1. The machine useful life from the lease commencement date is 5 years. The lease agreement allows S&A the option to purchase the machine at the end of the lease term for $15,000. S&A is reasonably certain to exercise the purchase option. S&A incremental borrowing rate is 15%, but rate implicit in the lease is 10%, which is known to S&A, the lessee. The present value factor of an ordinary annuity at 10% for 3 periods is 2.48685 to be used for the rental payment, and the present value of 1 at 10% for 3 periods is 0.7513 to be used for the purchase option. The present value factor of an ordinary annuity at 15% for 3 periods is 2.28323. And the present value factor of an ordinary annuity at 15% for 3 periods is 0.65752. Please explain to the members how this lease is classified, and how to calculate the lease liability. Although the lease term is less than 75% of the leased asset remaining economic life at the commencement of the lease term required to be classified as a finance lease, yet the lease is a finance lease because it meets the lease classification criterion of including a purchase option that the lessee is reasonably certain to exercise. The rate implicit in the lease of 10% is used to calculate the present value, PV, of the lease payments because S&A, the lessee knows this rate. The lease liability is calculated as follows. 1. The PV of rental payment equals $248,685, being $100,000. The annual rental payment, multiplied by 2.48685 plus 2. The PV of purchase option equals $11,270, being $15,000. Purchase option price, multiplied by 0.7513. Thus, the PV of lease payments is $259,955, being $248,685 plus $11,270. The journal entry to be made is debit right of use asset for $259,955 and credit to lease liability for $259,955. How does the lease liability appear in the lessee's balance sheet? In a balance sheet, the total lease liability is allocated between current and non-current portions. Based on the example above, could you please allocate the balance of the lease liability at the end of year one of the lease term between current and non-current liabilities? To allocate the balance of the lease liability at the end year one of the lease term between current and non-current liabilities, calculation of the reduction of the lease liability for each of year one and year two is needed. Reduction of the lease liability is the amount of the annual rental payment of a year minus the interest expense of that year. In doing so, the PV of lease payments of $259,955 at the beginning of the year one is multiplied by the interest rate of 10% to arrive at the interest expense of year one of $25,995. To arrive at the amount to be reduced from the lease liability at the end of year one, interest expense is subtracted from the annual rental payment of $100,000. Thus, the amount of reduction is $74,005. Accordingly, the balance of the lease liability at the end of year one is $185,950. To allocate $185,950 between current and non-current liabilities in the balance sheet of year one, the lease liability balance at the beginning of the year two of $185,950 is multiplied by 10% to arrive at the interest expense of year two of $18,595. To arrive at the amount to be reduced from the lease liability at the end of year two, the interest expense is subtracted from the annual rental payment of $100,000. Thus, the amount of reduction is $81,405. Accordingly, $81,405 is reported as current liability in year one balance sheet, and the remaining balance of $104,185 is reported as non-current liability, being $185,590 minus $81,405 equals $104,185. The session is up. We will continue to discuss this accounting standard in the coming sessions.